heroic. It just means outside your comfort zone. It's how you grow as a person. And
Okay.
so I am a cancer survivor and had
Okay.
chemotherapy, which left me with peripheral neuropathy in my feet. And so my brave thing was to see how I could improve my balance. And so
Oh.
dance was one way of testing that and improving it.
And so when was your salsa dancing career? When did that start?
About a decade or so ago.
Okay. All right. So it's recent.
Yeah,
All right.
I
Well,
no longer do it. But it was
oh,
a lot
you
of fun.
will. You will.
Yeah. I have daughter-in-laws that are really good salsa dancers, and they're
You
West
do.
Coast and East Coast. That's why I knew the difference.
Oh, so you were testing me, Charlie. Look at you trying to get me in trouble early in my morning.
Yeah, but yeah, I like the Latin dances. They're fun.
Yeah, super fun, super fun. And for those joining us, we're talking about salsa dancing here on the pre-show, waiting for people to come in. We know it's been a busy week for everybody. I think all of us are exhausted, excited about opportunities are coming our way, and so we're going to be linking that to salsa dancing. No, we're not, but uh, no, but we do want to see the picture of Charlie salsa dancing. So we are
No,
going to be following up on that as long
not
as
happening.
in
Not
addition to his
happening.
bank stock calls. Very two important things coming out of this show to this morning. Listen, we're getting people coming in here. Yeah, I think that between Powell and rates and I mean, maybe he's just going to resign to just say, you know what? Here's my answer. Goodbye. Good night. We'll see what he does today.
Yeah, I mean,
Coming
25
into
basis
post
point.
election.
Yeah, 25 basis points is pretty much baked into the cake. The question
Yeah.
doesn't say anything other than we're data dependent going forward.
Right. Right.
That's the
Well, I
um,
think it's hard, right? Because, if you don't know how policy could, affect you, it's going to be hard for them to really come out and say anything too strong, right?
yeah. But if he does indicate, more looseness ahead, the long end, I think, is really going to sell off, and that's going to be the monitor of his ability to move on the short end, because we're back to what June July levels on the long end.
Yes.
So all the benefits that the banks got in terms of balance sheet in the third quarter have gone away.
I
So
know.
we had significant improvements in capital as a result of lower unrealized losses in their bond portfolios in the third quarter. And when we wrote about that, in September, we said this will probably be the best quarter of the year. And it's, I think, showing that to be the case. But right now, no one cares about the balance sheet because everyone believes in the soft landing or no landing
Right.
scenario.
Also, increase in M&A, right? For those entities that participate in M&A. I think they're viewing the new administration as, opening up
Absolutely.
floodgates, less regulation,
Absolutely. And I'm going to go
approval
through those
deals.
things and how to quantify them.
Okay.
Yeah. But the one thing I won't talk about, but I do want to mention because I'm at this banking conference, is
Yeah.
two banks this morning did talk about seeing some margin compression and deterioration profitability in small businesses due to their variable rate debt, profile, the reliance on credit cards to fund their businesses, increased labor costs, and increased medical costs. So that small business area, if these are early warning signs, you want to pay attention to that in the first half of next year as to what's happening with credit there.
Right. And it's funny because I mentioned this months ago in our arrows how a lot of small business owners actually fund their business with their own personal credit cards. And so their leverage can have double impact if they've got problem in their business, right? It's not just a professional situation, it's a personal situation.
Absolutely. And there are two companies, that do provide public disclosure on small business credit. One is B of A, and the other is American Express. The banks this morning that talked about it were Wells Fargo and Truist.
Hmm.
So it's an interesting area to monitor. But by and large, the banks were very, very upbeat on the health of the consumer, obviously acknowledging, the deterioration at the very low end.
Right, right. Well, listen, it looks like it's time to get started. We are here on Thursday, November 7th. I'm Nadine Turman. It's Wall Street Beats. Hopefully, you're checking us out on Wall Street Beats. the site and getting notes from all of our colleagues. Today we've got Charlie Peabody, Berna Barchet, Russell Young. Because we started off with fan sales, I was actually going to go with Berna first, though. So we're going to come back to Charlie, even though he gave us a little bit, I guess, insight into where we're headed with our discussions today. He's over at a bank conference. So Berna, obviously a ton of information on the consumer, not just this morning, but yesterday as well. What's your take on what's going on? And does the new administration matter? Some of the things that Charlie's talking about. What are you seeing in the names that you're at least
Well,
following, if not investing in?
definitely a new administration matters because I saw the biggest subsector rotation that I've possibly ever seen in a single day in my career yesterday. It was unbelievable. And everything they say about, stuff being priced in, these are why markets are markets, because even when something is consensus and there's in a way no news, it's just shocking the moves that we saw yesterday.
So maybe
What
explain it for people if
I'm
they
gonna
weren't in their
talk
seat.
about that.
Yeah.
So what happened yesterday is you saw a massive rotation in subsectors in consumer. So my suspicion is what happened is I talk about the pods, the consumer pods. So there are masses of money at places like Millennium, Point 72, Citadel, Balyasny, where people have billions of dollars in these
Right.
sector sleeves that run market neutral within a sector. So if you're running a consumer cyclical book, you've got retailers, footwear, apparel, hotels, cruise, gaming, restaurants, all this that you might have housing, some housing
Always.
and auto stuff in there. Depends on how sometimes a little media. So you have to run market neutral. You have to have as many longs as many shorts on a delta adjusted, beta adjusted basis. And so what we saw yesterday was declines of 5 to 10% in what I would call as tariff exposed stocks.
Yes.
So footwear, apparel, retailers that sell stuff that they import. So, companies like Home Depot, Lowe's, Target, Walmart,
Yeah.
Five Below, dollar stores, etc. And at the same time, we saw 5 to 10% moves up in gaming, lodging, and leisure, just
Okay.
on fire. So your hotels, cruise, casinos, and related stocks, and also restaurants. And there wasn't a lot of fundamental news in the sector to drive that. Um, but what was shocking to me is that whether it was the betting markets or the polling or the Nate Silvers of the world, when we talked about the election the last couple of weeks, we never even talked about the scenario of Kamala Harris winning. Like everyone, you saw stocks like Fannie Mae and Geo, the private
Yeah.
prison operator, soaring before. So it looked like it was priced in. And so that kind of pivot is just, I've never seen anything more dramatic. We also saw it in, long energy, long Bitcoin. There was a lot of action in media and telecom, where I also
Right.
spend a lot of time because this sort of perception that the FT changes at the FTC, Lena Khan going, is going to open the deal to media mergers that were off the table. Within the Mag 7, you saw Google up, thinking like maybe they'll have some relief from their
Right.
antitrust issues. You saw all those stocks go up except Meta, because there is this perception that I've talked about before that Zuckerberg may still have the wrath of President
Right.
Trump ahead of him. So it
But
was
Bernie, can I ask you a
insane.
question?
Mhm.
So you're talking about the shift. So are you saying that this is mostly a shift of capital from
I
names
think
in the
it's a
sector
shift.
to other things versus new capital coming in? That's what you're telling
Oh
people.
yeah, 100% a shift of capital. I think it was
Yeah.
the pod. The way that it was like
Right.
certain subsectors going up, other subsectors going down, like with really 100% correlation to this theme. There were no outliers to this yesterday.
Yeah.
It just looks like there was a massive pivot on what I would call the consumer fast money in the market, which is these pods that run market neutral at the big multi-strat hedge funds. So today you're not really seeing it reverse, but you're seeing we had a lot of results today, and
Yeah.
you're seeing companies like Planet Fitness, which I talked about before, beat and raise. You saw Ralph Lauren Tapestry, these stocks are, even though Ralph Lauren and Tapestry are firmly in the sights of this tariff issue that's got
Right.
everybody pivoting, um, results are trumping, no pun intended,
Sure.
the thematic rotation today.
So
So
interesting, just so
I
you
think
know,
that
so I did get a quick note, Berna, that Tapestry's talking about, up to 40% of their goods made in China, right? And so they are looking to change their sourcing. So I think
yeah,
that if
but
nothing
it
else,
doesn't.
you'll start to see a lot of that communication going on, right?
Right. You're going to see a lot of that. I mean, I think it's important to understand that in footwear, there was a massive shift
Yeah,
already from China to Vietnam
right.
in the first Trump administration. So, but I think the problem with tariffs, because I've been sitting and trying to work out for my companies which are exposed. I mean, I kind of had my share of gaming, lodging, leisure, and restaurants, and to offset my retail and apparel was sort of a natural hedge that was
Yes,
there. But I'm going through all my tariff, exposed names and trying to figure out what the exposure is. I think there are a couple of things to keep in mind when determining the exposure. One is if you have a company that has material sales outside the United States, you have to
right.
remember that those products are never touching America. So for Crocs, for example, a stock that I talked about a lot that I like, 40% and growing of their sales are not exposed to this no matter what tariffs go
Right.
in. Okay,
Right.
so you have to, and yesterday the selling was pretty indiscriminate, and you saw some stocks and footwear go and apparel go down as much, whether they had 20% international or 50% international, which is frankly wrong, right? Like if you have
Mhm.
more international sales, you should not have been down as much. So there's some opportunities there parsing through it. I think the other thing to keep in mind is we don't know what these tariffs are. We don't know the order of magnitude of what they are going to be, nor do we know are they. Last time they were only on China, but there's a risk.
Right.
Like, what if they're on Vietnam too, and Sri Lanka and Bangladesh, and
Sure.
like the other countries that are major producers?
Well,
Is it
for
part
sure,
of?
because he's also talking Mexico and Canada. So my guess
Yeah,
is that's across, you're going to see
yeah.
some across the
So,
board,
so
right?
one way that I'm thinking about it is also just sort of is thinking about COGS, cost of goods sold, in
Sure.
and how the income statements work. Because if you're a company like Crocs that has near 60% gross margins, and you have a fairly low price product, so your product is only 40% of your costs, even if the cost of that goes up 30%. So say the cost of landing, and that includes the shipping, and logistics, not just the product costs, but so your $20, your shoe that landed costs $20 right now. If that cost goes up by 25%, it's now 25. So to fully pass that on, you have to take a $50 product up $5, which is
Yes.
10%, which is material, but it's still affordable.
Yeah.
And if you're competing against Nike and Deckers and everyone else in footwear who's also taking their prices up, but maybe they're starting from a lower gross margin and they're dealing with a higher price item with a higher landed cost item, they're going to be taking their prices up 10, 20, $30 to try to make it. So if everyone's raising prices but you're raising prices the least, that is positive for share, if assuming your brand is strong and everything.
Okay.
So I'm parsing through to look at gross margin levels, absolute ASP out the door to the consumer levels. So sort of what the percentage price change is going to be to the consumer and how that
Right.
compares to the competitors, as well as international exposure. I want
Okay.
to I want to mention one stock though, because I just want to
Okay.
follow up on one, sort of shifting gears a little bit, but here's a company that is tariff, protected, which had a great quarter on Tuesday. So I just want to mention that because we've talked about it before, which is the Real Real, which is the online luxury good consignment site, an app. So they sell Louis Vuitton, Gucci, Hermes, secondhand bags and shoes, the biggest part of the business. They also have jewelry, watches,
Yeah.
clothing, some furniture goods. This stock was up 20% on Tuesday on its results. It's up about 25%. It was also up yesterday, so up about 25% now. This was a lottery ticket that I was talking
Right.
about earlier in the year. It was trading at, maybe 60% of sales. Now it's probably at 90% EV to sales. This was You weren't paying a lot for a company that had a couple of years of cash runway to get their act together and become profitable. And guess what? Now they're EBITDA profitable. They're narrowing their EPS loss. They're going to get to profitability soon. They've got a new CEO, and all of a sudden, all the numbers are going the right way. So the
Okay.
stock is trading at less than one time sales. Their order size was up. Their customer count was up quarter over quarter. Sales were up
Hmm.
11%. And this company sources their inventory from your closet that sits in the
Right.
United States, and sells it to other people in the United States. So there's no tariff risk here.
Yeah.
And this lottery ticket is playing out the way that I hoped it would. It's up about 80% this year. But I think there's more to go here. So
Okay, so
real.
you're a holder here. You own it, you're a holder, or at least that's what you're looking for. You think that
Yep.
this is continued good execution,
Yep.
lower risk from tariffs, and the consumer, you think it'll stay buoyant, so therefore they'll um, get product and be able to sell that product.
Well, I mean, this company can work in a buoyant consumer
Yeah.
environment, and it can also work in a slightly weaker consumer environment, because this company is pretty much selling to the top 10-20% of
Yes.
households. And if they're feeling a little bit more squeezed, or
Yeah.
if if there's a tariff on France and Italy, and you start seeing the prices of Louis Vuitton and Gucci go up even more than they already have, which is basically 50 to 100% in the last 3 years, maybe secondhand becomes a better option for people,
Right.
because when you buy, the discount on a good condition Hermes bag is only about 10%, but for the other brands, it can be 20 to 50% lower when you get it secondhand in good condition. So
Okay.
it's a trade down beneficiary too.
Okay. Well, thank you, Berna. I want to get over to Charlie because I know he's at a banking conference and needs to pretend to be the banker. Look at him. He looks such like the banker today. So I definitely feel more confident in what you're saying today now that you have a suit on versus your fun shirt. So we talked a little bit about pre-show, but maybe we can reverse a little bit and cover what you learned at the banking conference, especially um, now that we have a new administration. How should people be thinking about this big rally in the financials from where we are today?
Absolutely, Nadine. But first, I'm going to eat a little crow because I recommended the cannabis stocks going into the election, and obviously that did not pan out well. So I just have to acknowledge that. I was looking for three things to help me. One was the legalization of recreational use in Florida through Amendment 3. That failed at 56%, needed a 60% approval.
Okay.
The possibility of a Harris presidency, because she wanted to legalize marijuana. That didn't happen. And the third thing was obviously the decriminalization, or rescheduling, I should say, of marijuana from level 1 to level 3, which would improve the cash flow of these companies. That's still on the docket for early December. But the bottom line is there's no reason to be in these names. I've been playing it through MSOS and Toke. If you followed Kevin Baker's disciplines, he told you that if Toke broke 6, you should get out. And so if you did follow his disciplines, you didn't get hurt too badly. I think the stocks
Okay.
overreacted, but there's no reason to be in them. So I just wanted to
Okay.
make sure you
Thank you.
understood I did that. So I'm here at this banking conference, and um, what I wanted to do is talk about, under this new regime, what's the framework for the upside in these bank stocks, and how should you think about it under the new regime? So the bottom line is that from pre-election prices, there's probably about 20 to 25% upside, and you saw anywhere from 8 to 15% of that upside yesterday in these bank stocks. So let me go through the pieces that people are thinking about. First of all, there's the tax cut. There are five pieces that I'm going to go through. The first one is the tax cut, because banks do pay tax rates anywhere from 20 to 25%. So if we get a lowering of that tax rate from 21% to 15%, that would add about 8% on average to bank earnings. And I want to stress on average, because there are banks like Citigroup, M&T Bank, Morgan Stanley, JP Morgan that'll benefit a lot more than 8%. But then there are banks like PNC, Wells Fargo, and Bank of America that will benefit less than 8%. But
Okay.
8% on average is the starting point. The second is there's likely to be a rollback of the proposed Basel III rules. At the very least, we're not going to hear anything on that until 26, maybe even 27. So banks will have excess capital now to do added buybacks. So on top of what they're already doing, you can probably add another 2% on average of buybacks to their earnings. Now, again, if you go outside the averages, you've got JP Morgan and Wells Fargo that can do much more in the way of buybacks. And at the other extreme, you have Goldman Sachs that somewhat is constrained, although they can do some 2 to 3% buybacks. The third thing is capital markets activity. Obviously, if Lena Khan gets sacked at the FTC, we're going to see much more M&A activity. And if these markets remain robust, we're probably going to see a lot more IPO activity. So we go back to the levels of activity that we saw in 20 or 21. You can add another 2% to the big banks' earnings per share from increased capital markets activity. And then if you think of Morgan Stanley with their big wealth management operation, well, assets just got revalued upwards by 2.5%, and you're earning a 1% fee on that. So that helps their earnings. So basically adding 2% from increased capital markets activity. The fourth thing that people are talking about is the ramp up in net interest income, or NII. And that's hard to gauge. You need more economic activity, better loan growth. And by the way, all the banks this morning said we're not seeing a pickup in loan growth yet, but they're optimistic it'll happen. And you can probably add 1 or 2% to your earnings per share if we get robust economic activity now that the election uncertainty has been quantified. And then the last thing, and this is the most important thing, there's been a lot of talk about less regulation of the banking industry under the Trump administration. And if we get less regulation, we should be able to appoint higher multiples to this industry. And so banks typically trade at the upper end, 55% of market multiples. I think we're going to see, that get to 60, maybe even 65%. So you can add at least 1.5% to your existing multiple, which is about a 9% increase.
So why is the multiple expanding? Can you let people know, walk through the view on that? Why multiple expansion?
Well, there's less regulatory risk.
Okay.
So one way of thinking about it is there is a lot of added expense costs associated with regulatory risk. And then there is obviously the headline risk with regulatory. So we think there'll be some multiple expansion related to less regulation. We'll see how that plays out, but that's an important one because that could add 9%. So, if your upside is 20, 25%, you've gotten 10 to 15% of that yesterday, you probably have another 5 to 10%. And, my guess is I wouldn't stay around for the last 5%. So you probably only have another 5% upside from here.
Okay.
I do want to emphasize right now, because everyone believes in this soft landing or no landing scenario, the focus in banks is all on the P&L. And that's what I ran through, is what the P&L impact would be. And they're ignoring anything to do with the balance sheet. We have seen a dramatic reversal in interest rates. At some point, that's going to matter on the balance sheet. And where that matters is hard to figure out. That's the art part of this market, not the science part. I think it's going to matter if we get the 10-year up to 470, because that's where this whole equity rally started in April, May, with the 10-year yield falling from 470. So I just want to mention these.
So maybe walk through that a little bit, because you're just saying that that if that happens, there's some potential issues on the balance sheet. Can you give your thoughts on what people should be looking for on the balance sheet if that's not where they're focused? Just so that it may make sense to you, and I know that we'd always talk offline, but can you summarize it for people of what they need to be looking for?
Sure. The most obvious is what's happening to the fair value of the assets as rates rise. And a specific example is banks do hold a lot of mortgage-backed securities and treasuries on their balance sheet. And those start to lose value as rates rise. No one is worried about that, but that's what got Silicon Valley into trouble.
Right.
And no one's worried about that right now because you're not seeing an outflow of deposits in the banking system yet. We have drawn down the reverse repo facility to fund the Treasury deficit by order of $2 trillion, and we're down to only about 200 billion left in that reverse repo facility. So
Yeah.
at some point, deposits are going to have to flow out of the banking system, either because they want to find higher rates elsewhere, or because they have to fund this Treasury deficit that's growing. And so, if deposits start flowing out of the banking system, that's when these unrealized losses will matter. The
Okay.
second thing, obviously, as it relates to loan demand, it's unaffordable right now to buy a house. It hasn't gotten any easier with rates rising. Same things with boats, cars, et cetera. And then, what's happening to the value of your residential mortgage portfolio as rates go up. So those are the things you have to be considering. I would watch deposit flows and excess reserves. If those start to flow out of the system, then I think these unrealized losses will matter, but not now.
Okay. Thank you. Anything else, or should we let you go to your event over there? What anything else that you
I'm
want to highlight for
trying to
people?
get back to the event. It's just so exciting. The
All right.
banking.
Well, I know that Russell's been trading here. That's why we haven't seen his beautiful face looking at us. Great. So
Yeah.
now we get his beautiful face looking at us. So Russell, what is going on? What are you trading over there? I know one of your stocks had a big move. Fill us in.
Yeah. So I've been talking about AppLovin on the program, and they crushed the quarter, and they raised their EBITDA guidance for next quarter by over $100 million, right? And so the numbers just exploded upwards, and the stock is, I don't know, up almost 50% now. And it's interesting because there's been a lot of skepticism around this company on the belief that changes to Apple and Meta would ruin the company. But if you listen to the conference call, it was probably one of the most exciting calls that I've heard all earnings season, where they're saying that they're going to grow sequentially at least 5%, then with step ups beyond that to move to new levels. They're moving into the e-commerce advertising segment, and they said this is the best product that he's most excited about he's ever seen. And what's crazy about this company is they had over 100% of the incremental revenues drop straight to the bottom line, right? So think about that. All incremental revenues go right to EBITDA. And what I think what's going on in the market this morning is people are looking at this company, and AppLovin says that they have one of the largest GPU clusters in the world right now. Right. Okay, and so there's this, you have the Ben Bray saying there's no application for AI, this is all stupid. And yet you have companies like Palantir and AppLovin that are deploying these huge AI clusters and are making fortunes. You're seeing their numbers just explode. And so that's been my argument, is that we're going to see AI not in an application on your web phone, which is everyone expecting, but in being applied to businesses. And so it wouldn't surprise me that if people are looking around from AppLovin and thinking about the AI plays on either building out data centers, and that any company with a huge AI cluster is now suddenly going to look at, like, what do they have? I mean, I think like skepticism around Tesla's AI driving, I think that's going to show to be misplaced, because Tesla's going to start making these big improvements, and it's going to start blowing people away, which is just what happened at AppLovin. So that's what I'm thinking about today. ARM, I thought the numbers were fairly lackluster. They didn't give very many details. They said they're getting a lot of traction in AI, but it's mostly, it's mostly smaller applications like cell phones and cars, but they're talking up an AI, and it's getting an AI bid. But you look at the contrast between AppLovin and ARM, and it's just no comparison on who's really benefiting from AI. I mean, ARM has 5% year-over-year top line growth. And it seems to be super expensive to me. It's still tight. It means hard to borrow.
Sure.
A small percentage of the shares are in the float, so it's trades to baffle people who are looking at the valuation. And their big idea is SolarEdge reported last night, and it was just a disaster of a quarter. In past quarters, the U.S. was only 15% of business. Now it's up to 50%, and after charges and everything else, they took $1 billion loss in the quarter. Net cash is down to $50 million. Okay. And They're going to burn, I think, 20 to 40. I can't remember the exact number again this quarter. So I mean, the solvency of SolarEdge is really in question, and it just shows what's going on in this market. And I'm still bearish on Enphase. I think this stock's going below $50. If anything, maybe if SolarEdge gets really in trouble, that would benefit Enphase. But SolarEdge is ramping up hard in the U.S. and they're slashing prices. In between Tesla coming out with the Powerwall, I think that's super negative for Enphase. There's just a glut of product. Pricing is coming down, and that's just a mess. So yeah, that's what I'm working on this morning.
So I want to go back to AppLovin. It's a name that I know. I can't really go into why I know it, but can you tell people what they do, because they might not be as familiar with that name? So tell them what they do. Then I have a couple questions or points for you for that.
Sure. So what AppLovin does is they have an in-app advertising platform, okay? And so that you decide how much budget you'll give them and they get paid for performance. So it's not like your traditional advertising company that says, I want to spend this and I have no idea what the return is going to be.
Right.
They get paid for conversions, okay? And so if a company is doing well with AppLovin and getting the downloads and the business they expect, they keep on pouring more and more business to AppLovin. And so that's worked and started off in mobile games and now expanding to applications. And what they're doing now is they're blowing out of the app ecosystem and moving to e-commerce and getting onto the overall web. And they're going to start going after Trade Desk. And so what they do is they're great at connecting data points together, right? As they see who you are on your phone.
Right.
They back into all your information. And it's like, look, this is a guy sitting in this area. Now we know what kind of car he drives. We know his general income. And this is the type of ads we're going to serve him. So it's very, very targeted and high ROI, a high return for people doing the advertising. And so they're really taking predictive engines and applying it to advertising. So that's what they're doing.
And I think they're your point. So I want to connect that to, Ben and I have a podcast. We had a good friend of mine, Suba Tadavarti, on. She was the former CTO of Wipro, and does a lot of global implementations of AI, right? And so one of the things she was talking about, which echoes, I live in the Valley and hear a lot from VCs, it's really about business applications, and it can be those revenue drivers. It's not just reducing costs, it's revenue drivers. I think that that's a point that you're making here, is that some people are spending on whether it's these data centers or AI, and it's changing the business model, the performance of that model, which it sounds like you're seeing the strength in this company this quarter on. Is that fair to say?
Yeah, absolutely. And I'll call out another company that I'm looking at is, Root Insurance, okay, had a big move last week. And analysts are largely sitting on their hands saying, oh, we're not raising our targets. And everyone's very flat-footed on this. But this company is doing the same thing, is that they're taking AI and applying it to insurance results. And, it's a little bit like Progressive, where they use telematics to see if you're a good driver or not. And, so they're using AI and all this predictive modeling to say, okay, look, and this is unique because they don't want to insure crappy drivers who are going to have accidents, right? They only want to insure high quality drivers who aren't going to have accidents. And so what we've seen in car insurance is everyone is getting rate increases, right? State Farm is increasing my rates by 20%. And so with all these rate increases going out, is people are going to be shopping for cars. And so companies like Root that are applying intelligence, you're seeing this massive inflection in their earnings. I mean, I think Root could earn over $12 next year, and it's an $80 stock. And people are looking at the stock chart and thinking like, oh, it's been bid up too much. But, these are what I'm looking for, right? Companies that are taking AI, applying it to their business, and people aren't paying attention to it yet.
Great. Well, thank you. Listen, I know we're past the 7:30 hours. A lot going on this week in the markets, and you're getting a tired team because we've been glued to our seats. So please check us out on the website for Wall Street Beats. You can subscribe and look at the research that people are doing, understand the ideas a little bit more. We'll catch you back tomorrow. It's Thursday, November 7th today. Again, Nadine Turman, we had Bernard Barchet, Charlie Peabody, Russell Young, now with his beautiful face looking at us. So we'll catch you back another time. Thank you.
Yeah.